Forecasting financial statements. In this lecture, we will be focusing on developing a financial plan or a forecast for a business. Forecasting future is obviously one of the most difficult things. However, being difficult does not render this optional. If we do not have a plan or a forecast before us, we may not be able to harness any of the opportunities that future may present, or we may fail to meet the challenges that lie ahead. So therefore, planning ahead of time has paramount importance. There are a number of approaches that can help us develop forecasted financial statements, but the simplest approach is the percentage of sales method. This method takes on a simple approach and ties most of the elements on income statement and balance sheet to one key variable, that is sales. An estimate of sales of the period in question becomes the starting point of our forecast. This estimate may be developed internally by interviewing the sales staff about how they view the market going forward. Alternatively, the forecast may also be developed based on macroeconomic fundamentals and how they relate to the sales of the firm's products. In either of the case, we have a forecasted number for revenue to start off our financial forecast. One of the key objectives of developing forecasted financial statements is to ascertain any addition requirements of funds or any forecasted cash surplus in future. Knowing about deficits or surplus in finding beforehand can actually help us meet the funding gap more efficiently, or we may alter our course accordingly to avoid an undesired situation. So how do we go about starting a financial forecast? Well, first we must analyze the past income statement and balance sheet to look for any significant relationships that we can identify as to how sales relates other key elements on the income statement or the balance sheet. We can have a deep dive in establishing how each time on the income statement or the balance sheet corresponds to sales or changes in sales, and how developing various strategies can impact these relationships in a manner beneficial to the firm. However, for this course, while developing our first financial forecast, we shall keep things very basic and simple. This shall help us develop a thorough understanding of the larger picture. Once you have a clear understanding of the process of developing a forecast, you can easily venture into developing complex financial modeling, while defining various complex relationships among the variables at play. To start with, we can establish gross profit margin, or net profit margin from the previous year, or average of the past few years, to establish how income statement would look like when we plug in our forecasted number for sales of the coming year. Many elements of the balance sheet or the income statement do not correspond with sales or changes in sales. We don't need to worry about these at the moment. We can explore the key drivers for these elements in some advanced courses, but for now we can assume that these would stay unchanged, or can take any other value that we may assume. So we shall proceed with developing our first forecast of financial statements by identifying simple relationships of a few elements with sales, and prepare a forecasted income statement and balance sheet based on these assumptions. Next slide takes us through this process using an example of a hypothetical firm. For developing our first set of forecasted income statement and balance sheet, our starting point will be these statements from the last year for this hypothetical firm. As we can see, that this firm registered a top line of $50 million while incurring cost of goods sold of $37.5 million. This translates to gross margin of $12.5 million. Here we can also observe that the gross margin for this firm stands at 25% of sales while selling. General and administrative expenses are recorded at 6% of sales. We don't any other items on the income statement that tie up with sales in any significant manner. Here we have the balance sheet from the last year. We can observe that the firm maintains cash about 2% of sales, while inventory and receivables stand at 20% of sales each. Net fixed assets do not have any significant relationship with sales. Moving to the other side of balance sheet, we see that payables balance is maintained at around 1% of sales, while accrued liabilities, long-term debt and balance of common stock does not have any linkages with sales. The balance for retained earnings is updated for transfer of any residual income after payment of dividends from net income. This firm has dividend policy stating that half of the net income each year is paid out in form of dividends, while the other half is added. while the other half is added to retained earnings. For the last year, addition to retained earnings was $2,752,000. So, before diving into the mathematics of forecasting, here we summarize all our assumptions that go into our forecast. First, we expect the cost of goods sold to remain 75% of sales. The other expenses will remain at 6% of sales. Interest expense and taxes to remain at the same dollar amounts going into the next year. The firm is likely to maintain a cash balance of 2% of sales, while maintaining inventory and receivable balance at 20% of sales. Outstanding payable shall remain at 0.5% of sales. Rest balance sheet dollar amounts to remain the same. Sales growth is forecasted at 15% over the previous year. So, here we have our forecasted income statement. Based on our assumptions, the sales grew by 15% over last year. Last year's sales was $50 million. So multiplying 50 by 1.15, we arrive at $57.5 million. COGS shall remain at 75% of $57.5 million, which comes down to $43,125,000. Other expenses which we assume to arrive at 6% are $3,450,000. $2 million each for taxes and interest are also recorded here. Rest are all calculated based on these numbers. Half of the net income is paid out as dividends, while the remaining half shall be added to last year's balance of retained earnings. Last year's closing retained earnings were at $9.5 million. After adding this year's balance becomes $12.96 million. On this slide we have our forecasted balance sheet. Cash, inventory and receivable balances are 2%, 20% and 20% of sales. That is $57.5 million for our forecast. Payables reflect a balance of 1% of sales. That comes down to $0.575 million. Other balance sheet items remain at the same dollars amounts as per our assumptions, while the balance for retained earnings is updated for the addition of $3.465 million. It is evident that both sides of our balance sheet remain unequal at this point. This highlights the fact that the asset side has outgrown the right-hand side of the balance sheet. Thus, the firm needs to raise additional finances to support the growth 15% in sales. We find out this amount in the next slide. So the funds required to support an increase in sales by 15% in the next year, the firm must arrange external financing for about $10,610,000. We arrive this number by subtracting total liabilities and equities on our forecasted balance sheet from our total assets. Sometimes, this number is negative, which signifies that the firm generated a surplus cash, and there may be a need to deploy this surplus liquidity, and we must plan accordingly. This concludes our lecture on forecasting financial statements. An assignment is available on the Learning Management System to help reinforce the concepts learned here.